Business models are the way that you translate the idea and into product and eventually or delivery of value, and then how do you capture that value. To figure out what the value is and how to capture it, you need to do some financial projections. And tonight we have another one of our highly paid, overcompensated volunteer speakers, Charlie Tillett. Charlie was a semifinalist in the 10K back in the day?
Third place.
Third place. And I think you said you worked out to about 30 cents an hour?
The prize was $300 in 1990 was the year.
Since then, Charlie's gone along and done a number of serial entrepreneurial things, including from a startup company to IPO and then several other companies. He's also an avid golfer, more so today a skier. He's going to be leaving us next week to go heli-skiing somewhere. So I'm glad we caught him ahead of time because who knows on these heli-skiing things. So Charlie Tillett. Oh, by the way, his template that you will see tonight has appeared all over the world. I was in Istanbul mentoring a team from Pakistan. And I look at the financial projections and I go, where did you guys get this? And they never quite figured out it was Charlie's. So he's worldwide. Charlie?
Great, thank you, Joe. I'm glad to be here tonight. I've got about twice as many slides as I should have, so I'm going to go through them fairly fast. But don't be afraid to speak up and ask questions if there's stuff that you want me to go into a little more detail on. But we will get done on time. So in order to think about your financials, we're going to look at what venture capitalists are looking for in them. So you have to understand your audience. So just like your product, you have to understand your audience and what your customer is looking for. When you're putting together your business plan and your executive presentation and your elevator speech, think about your customer for that. And what that customer is the potential investor if you're trying to raise money. And let's kind of just spend a few minutes looking at it from their eyes so you can understand their perspective. And I would say that the 100K judges are going to judge this just like a venture capitalist would judge it. The second part is kind of talking about your business model. We're going to look at a number of business models, some of the same companies that Rich was talking about. I've got their financials, and we'll look at them and see how they're the same, how they're different across a couple of industries and within that industry. And then we'll dig into building your financial model. I've got some rules of thumb. I've got a spreadsheet template that will be up on the web that you can use as a starting point for putting yours together. And then we probably won't have enough time, but this presentation will be on there. There's some slides at the end to talk about sharing the pie. And that's not sharing the equity with the investors, but more thinking about your founding team and your employees and perhaps your advisory board, and thinking from the beginning holistically about how that equity is going to get divided so you don't make mistakes in the beginning that become very painful at a later date. But we might have time to get into that. As Joe mentioned, I'm a 91 Sloan grad. I was third place in the 10K contest, and I did spend a summer as an intern at a venture capitalist. And what I realized is everyone thinks venture capitalists don't have a lot of patience because they're always pushing their entrepreneurs to go faster and to get more things done. But what I realized spending a summer there was that they have an incredible amount of patience because they put the money in and they really, it's like buying a boat, right? They say there's two days that you're happy when you buy it and when you sell it. It's the same with the venture capitalists. They're happy when they put the money in, and then they're happy when they get the money out, and everything in between is kind of painful. NetScout Systems was in the network diagnostics space, monitoring tools for large enterprise-wide networks. I was employee number 10. We had a number of VC financings and went public in '99. And then I worked for a company that made explosives detection equipment for aviation checked baggage. Again, I was part of the founding team there. We grew that to about $100 million in revenue, and that was sold for $230 million a couple years ago. So all in all, I've raised $125 million, but not in big transactions, everything from $500,000 to $10 or $20 million. But it's been I will tell you, every transaction, whether it's for $500,000 or $1 million, they're just as painful as the transactions for $10 million or $20 million. So, as Joe mentioned, I usually come to give this talk just before I'm getting ready to go skiing with a bunch of buddies of mine. And one year, I invited this friend of mine to join us on a trip. And he said, "Yeah, but I'm going with some guys on a golf trip. And we're going down to Hilton Head." And I said, "Yeah, but we're going to go skiing." He said, we're going to be at Hilton Head, we're going to be right on the ocean, and we're playing all the greatest courses there. I said, "Yeah, but we're going to Alaska." And so after a lot of cajoling, I did get him to come and join me in Alaska. And this is an actual picture of a slope that we were on. It is, as our guide said just about before the start of every run, there's a lot of consequence here. Really try not to fall. So we were standing there, the two of us, and our guide had gone over the edge and had disappeared and then popped out about 10 minutes later. And our skis from about the boots forward are flapping in the air because the slope is so steep. I said to him, "Carl, do you ever get this feeling in the pit of your stomach when you're lining up a 2-foot birdie putt?" So the point of that story is, and just to show you how we actually got to that slope, and you might notice the helicopter, the back skids are in the air, but the front skids are in the air as well. So this was more of a controlled hover than an actual landing. But the point of the story is that as you're at school here, you have a tremendous amount of career opportunities, and one is to go work for any of the number of great technology companies that come to MIT and hire MIT graduates. And the other is to go off and get involved in an entrepreneurial company. And what I would say is that going to work for a large company, it's not that it's not a great career, but it's more like going to play a round of golf. Whereas getting involved with a startup, that's like standing at the top of that slope with the front of your skis flapping in the breeze there. You get that energy every morning when you're coming in, because life is a little bit more on the edge when you're at a company like that. And the reason why going to a startup right out of school here is something for you to consider is, number one, unless MIT's gotten a lot easier since I was here, your workload is already about up here, right? About as much as you can handle. So you'll go work at a startup company, you'll work like crazy, but you'll still have Sundays off, right? So you'll say, "Wow, this is pretty good. I've got a lot of free time." The other is, you're probably used to eating pizza about 3 or 4 nights a week. So you'll start getting a paycheck. It won't be a lot, but it'll be enough to, maybe go out once or twice a week. So what happens is, the people who say, "Oh, I'm going to go work a few years, and I'm going to pay off my debt, and then I'm going to go join a startup," the lifestyle creep gets in. They buy a new car, they get those car payments, they get the house payments, and then before you know it, they can't afford to join a startup. So my friends who went into consulting are still in consulting. And my friends who went and worked for large companies are working for other large companies, but none of them have really, very few of them, I won't say none, but very few of them have been able to step back. So that's my minute on the soapbox. So let's get into the presentation. Reveal was kind of the classic startup where we had 10 guys in a barred conference room and a whiteboard, and our chief technical officer had kind of sketched out this design of the machine that we were going to build. And at that moment, we started we knew that we needed a lot of money we had a window of opportunity to get these products into one of the 492 commercial airports in the United States. And once they had a product from one of our competitors, they were no longer an opportunity. So we had a window of opportunity to get a machine certified and start selling it. And so we knew we needed to raise a lot of money, and we needed to do it quickly. So from that meeting, I got on the phone and started calling friends and family. We raised an angel round within about 3 months of $1 million, and within 6 months we closed a venture round. And as soon as we closed a round of financing, or maybe even before we closed that round of financing, I was always thinking about what's the next round of financing that we're going to do. What's that round going to look like? Is it going to be equity, or is it going to be debt, or is it going to be based on assets, or are we going to be able to get some unsecured financing? And who is the right audience to provide that financing? So who do we need to start talking to? And how much can we raise at this stage? And how much do we need? And it was the business plan that really helped provide all those answers. It was what told me how much money we were going to need and when we needed it. And then it was the vehicle that as we started approaching those people, we were able to present our financials and show them how much we would get done by a certain point and what our financials were going to look like at the time we hoped to raise the money, and then a year from the time that we raised that money. So let's spend a few minutes thinking about the venture capital investor and what their mindset is. They're looking to make 3 to 5 times on their investment in absolute terms. Not in IRR terms, but if they put $5 million in, they want to get $15 million out. So that means that they've really got to get $20 million out because the first $5 million is just returning their principal. And they'd love to get 5 times out, right? So they're setting the bar pretty high. And of course, they'd like to do this in 5 to 7 years. And these funds are set up with a 10-year lifespan. So usually the first 2 to 3 years are the investment period. And so really they've got to plan on getting those investments out in 7 years because they're trying to wind the fund down at the end of 10 years. And if you do the math, I mean, it sounds outrageous, but it really works out to an IRR, internal rate of return, of 32% compounded over that period of time. But there's more to it than just getting the return, right? If they can put in $100,000 and get that return, they're not interested. Why? Because they need to get a significant amount of money invested. These funds all are now in the several $100 million range. And so putting in $100,000 and even getting a 10x return or a 20x return doesn't move the needle on a $500 million fund. They want to get $5 million or $10 million. In fact, everyone thinks that they'll have more success if they go out and try and raise a little amount of money. You're actually more likely to have more success, assuming that you have an equally good idea, of raising a lot of money, because you're helping the investors with their problem. And their problem is, I've got $500 million, and if I don't get that money to work, then I don't make money on that money, and their deal is they get 20% of whatever they make. So money that they don't make is 20% that they don't get to keep. You know what I mean? So the formula, and then they also want to own a significant ownership percentage. Now, if there's multiple people coming in, this is a little bit more fungible than this first part, but in general, they want to own around 50%. And don't get too worked up over 51%, 49%. At the end of the day, if they've got a significant amount of money in your company, they've got enough terms and conditions, restrictions on that money and seats on the board that it really doesn't matter whether they've got the 51% or 49%. The formula for how much they get of your company is the percentage that they get is the amount that is invested in the current round divided by the pre-money valuation plus the amount that's invested, with the pre-money valuation being the company's value prior to the current investment. So we'll go through some examples on that. Now look, at the end of the day, we raised at Reveal, we raised $5 million on ended up, let's call it a $5 million pre. It ended up being $6 million pre. But we raised $5 million on a $5 million pre. What was the value? That said the value of our company, which was 10 guys with a sketch on a whiteboard, was worth $5 million. So that doesn't mean that someone will come in and actually buy your company for $5 million. It's just, it's a it's the formula, and it's the terms of the negotiation. So whenever, and also, kind of be aware, so post-money would be the pre-money plus the invested. So as you're talking to investors, they'll throw around these numbers kind of loosely and freely. Yeah, question here?
Could you go over what pre-money is?
Yeah, so the question is, what is pre-money? And so pre-money is, what's the value of your company before this investment comes in? It's a little bit easier to define for the second investment, and we'll go through an example, and I hope that if that doesn't answer your question, ask it again. Okay? So in this case, at Reveal, we did a Series A round. $5 million was invested on a $5 million pre-money. So if we look at the math here, right, it's 5 over 5 plus 5, right? They got 50%. So then in our Series B, it was $10 million invested, and so our post-money in this case was the 5 plus the 5. So our post-money was $10 million. We then got our machine certified and reached some milestones. And at that point, we went out looking for funding again. And so we had done more. We were on a positive trajectory. And so the starting point for our negotiations was the prior value, the post-money of the prior round. So we were already at $10 million. We said, we've made a lot of progress. We think $15 million. We said, we think $25 million. They said, we think $12,500,000. And so we agreed, we negotiated it to $15 million was the, and in this case, 10 million on a 15 pre would be 10 million divided by 25, the combination of those two, would be 40%. The thing to consider is that the investors who came in the first round get diluted by the 40% as well. So their share is decreased. And again, I have a spreadsheet here that'll kind of show that. In this example, the investor has invested $15 million, 5 and 10, and they own 70% of the company, right? The 50 that got diluted to 30, and the 40%. So that gives them 70%. So they own 70% of your company, and they have $15 million invested. So if they want to get 3 times on their money, they need to get $60 million back. And if they want to get 5 times on their money, they got to get $90 million back. And if they own 70% of your company, that means your company has got to be valued between $85 million and $130 million. And the final point on this is, in order to get your company valued at that, if you use a conservative revenue multiple of 2x, you'd say your revenues need to get to $42.5 million and $65 million, or 65 million, to warrant a valuation of $130 million. I take a look at the company at Reveal. We got the revenues to $100 million. We sold it for $230 million. Our investors, it played out perfectly for them. They actually made more than 5 times on their money. Yep.
Will you talk about the pre-money valuation, how that works out, how it's...
So, so the question here, valuation. At the end of the day, so I had a conversation with a venture capitalist friend of mine over cocktails at a Christmas party. And this was after this was right after the tech bubble, right? This was like 2002. I said, hey, Roger, how are things going? He said, things are going pretty good. I said, hey, you seen a lot of investments? He said, yeah, we're seeing a pretty good stream. We're still very active. I said, what's different these days? He goes, well, we still like to get about 50% ownership in the company. And before this before the meltdown, we were paying $10 million to get that 50%, and now we're only paying $5 million to get the 50%. At the end of the day, they wanted to get 50% ownership in the company, and they want to do it for as little money as possible. But a reasonable company is going to need $5 million to fuel that growth over a period of about 2 years. And I mean, your business plan is going to tell you how much money you need. But $5 million generally will give you, unless you're doing something, unless you're buying ads at the Super Bowl, you can hire a lot of people and support yourself for, a good 18 to 24 months on $5 million. And that gives you enough time to make something, to get some customers, to show progress, and then you go and do the next round of money. So it's not really the value of your company, of your 10 guys and your idea on a whiteboard. It's the prospect of what you can grow this thing to. Okay. So here's our example here. And so the founders had a kind of a randomly assigned to 2.3 million. Key early employees took another chunk, and some advisors got a share. Then we brought in angels at 10%, and they put in $500,000 at a 4.5 pre, which meant that they got 10%. And then this share number becomes whatever you plug in to get them to 10%. Your venture investors came in $5 million at a $5 million pre. You plug in whatever share number gets them to 50%, but they're going to add a requirement that your option pool be set to at least 10%. And I've heard them say that they want an option pool of 25%. But you can usually, it's a negotiating point to figure out how big that option pool is going to be. And what that means is that as you hire employees, they're not getting diluted by the shares that you're giving to your new employees. And then the final round here was the 10 million at 15 million. That was 40%. You just plug in whatever shares gets them to that 40%. In real life, it never works out to nice, even numbers here, and the share price is always, something that's 4 decimal places long. But it's whatever it comes out to be based on the negotiation. So let's look at the income statement. As we're trying to put together, we're going to look at a bunch of different companies. So let's walk through the income statement so everyone understands it. Sales or revenue, that's whatever you're selling. Whatever number you're putting on the invoice and sending that goes out to the customer, that's what sales or revenue is. If there's any discounts that you're giving, it's after those discounts are taken. Cost of goods sold it's the labor it's the material that goes into your product, it's the labor that goes into your product, it's the cost of the manufacturing space, it's any packaging that goes with that. It's also customer support. So if you give them a year of technical support, or if they're allowed to make returns to the product if it's defective, that's going to go into your cost of goods sold. What's not going to go in there is your engineering staff, okay, your programming staff. They're going to be down here in the research and development. Now, you might have some technical support people working the phones, as supporting your customers, and those would be part of cost of goods sold. So then you've got your 3 main departments: sales and marketing, research and development, and then general and administrative is kind of anything that doesn't fall in the other categories. For a simple business plan, this is also where you would put your facilities. It's always where your HR staff would go, obviously your accounting staff, the CEO goes in there, the CFO goes in there, and the other C-level officers would go in there, their respective department. So that gives you your total expenses and your operating profit, or earnings before interest, taxes, depreciation, and amortization. And again, for the type of business plan that we're putting together here, you do not want to be allocating a lot of expenses or doing a lot of depreciation or calculating taxes. It's just everyone knows that you're going to have tax loss carry forwards, and eventually it's a good thing to be paying taxes, right? That means not only that you've made enough money till you used up all of your cumulative losses to date, and now you have to kind of pay the piper. That's a good thing, right? No one likes to pay taxes, but it's better than the alternative, right? So that's your income statement. And then these are just percentages all kind of divided by revenue. These are all percentages of revenue. So I get sent a lot of business plans. And what I look at, and what I think most investors look at when they get a business plan, is the first thing that they look at is the top line. How big is this company going to get? Is this credible? You know, reading a little something about the company, you know, whatever the company's doing, do these numbers look credible? Are they too low or are they too high? I mean, you could put together a business plan that shows you growing to $5 million in over 4 or 5 years that's extremely credible, but an investor, certainly a venture capital investor, is going to look at it and say, how can I get my 5 times on my money on a business that grows to $5 million? Because the market for that business, there really is no market. No one buys $5 million businesses because the companies that do buying are generally large companies, and $5 million, unless it's some really sexy technology that they've just got to have, they're generally not going to be interested in a company that's that small. The next thing that I look at is what are the percentages of revenue out here? What's the business model really in year 4? And whether it's year 4 or year 5, however far out it goes. And what this tells me is, does this business, you know, what are the costs of goods sold for this business? Are they high or are they low? Because a great bottom line really starts at the cost of goods sold line. I've worked in companies that may have an 80% gross margin and companies that have a 45 to 50% gross margin. I can tell you it's a lot harder to make money when you have a 45% gross margin. You really have much less margin for error when your gross margin is not very high. You can do anything you want. When you have an 80% gross margin, you can spend money on almost, as I used to tell my CEO, I said, we can spend money on anything we want, we just can't spend money on everything we want. But if you don't have that kind of gross margin, sometimes you can't spend money on anything you want, right? And then look at the departmental expenses and look here. What's the bottom line? What's the operating profit for this business? And then the next thing that I look at is what's the operating profit by year? And this gives you a good sense of how much money this business is going to take to reach critical mass. So here it's $3.5 million, $2.5 million, you know, it's roughly $6 million, right? And so you get a sense that this business, I don't know, maybe they were losing money in the first or second quarter in year 3 before they turned profitable. But it's a business that needs, I don't know, $6, $7, $8 million to get there. It's not a business that needs $40 million to get there. Or it's not a business that only needs $1 or $2 million to get there. It gives you a sense of you know, what this business, how tough a row it has to hoe. When you're putting together your plan, I think you should start at the same place. Look at the top line, and because you're going to be asking yourself, how big is this market, and how big is the segment that we're going after? Likewise, look at your business model out in year 4, but instead come back to year 1 and look at the real expenses, because as you sit here today, you can think about, well, what are the key 10 or 15 hires that we need to make? Or maybe it's 20 hires. Do we need 20? Do we need 30 people? How many people do we need? And what's the material that we need? And you can kind of visualize how much space do we need for 25 people, right? And you can go out and figure out how much that's going to cost. So these expenses in year 1 should be pretty easy to get, you know, a pretty good guesstimate of. You know, here's what we hope to accomplish in the next 12 months, and here's how much it's going to cost to do it. And while year 2 is a little more speculative, you know, you can extrapolate from that year 1 and ramp those expenses up and still come up with a pretty credible number. Obviously, predicting where your revenues are going to be in year 1 or year 2 that's more guesswork. But predicting what your expenses are going to be in year 1 or year 2, that you should be able to do that pretty well. And then look at where your business model has you in year 2. And all I would say is that what you want to do in year 3, or if you have a 5-year plan, year 3 and 4, is really kind of smooth these numbers out so that you get from here at 29% down to 16% in kind of a nice steady, not steady necessarily, but that it always moves in the same direction. You don't, your expenses as a percentage of revenue shouldn't be doing this over quarters or over years unless there's some reason to do that. So, because you're going to get questions on it, you go, well, why did R&D go up in year 3 and come down in year? Why would it go up and then down and then back up again? Is there a reason for that? Now you might have a perfectly valid reason for that. So, for example, in the beginning, sales and marketing is very low because you don't have a product to sell. And then year 2, you're introducing the product, so you're going to have tremendously high sales and marketing. And then in year 3, you're more established, and those sales and marketing expenses can come down as a percentage of sales. It's a perfectly logical story, so it makes sense. But your other expenses shouldn't hop around all that much. As we think about, these percentages, it tells the story of how your business makes money. And as we've been talking about, it's in percentage terms. And always think about what your business is, what your business is going to look like once it reaches some critical mass. And critical mass could be volume. You may be getting economies of scale in your manufacturing or from your supplier. There might be geographical economies of scale where if you have one location, let's say you were opening a chain of restaurants. You have one location, but you advertise on the radio. Your one location has to take that whole burden. But if you've got a regional chain, you can advertise on the radio, and all 10 restaurants can benefit from that and share that expense, right? So think about what the critical mass items are for your business. So let's look at some businesses. So in the retail side, I think someone was talking about Target and Nordstrom here. These businesses are characterized by high cost of goods sold and low gross margins, although a little bit, we'll come back and look at Nordstrom in a second. They don't spend anything on R&D, and operating profits in the single digits to low double digits, right? And what you can tell about Nordstrom is a higher end store, much more customer service than they probably have more employees in the shoe department at Nordstrom than all of Walmart, right? You ever try and find someone to help you there? So Nordstrom is able to get away with higher gross margins, but the payback is they have much higher sales expenses there, SG&A. And I would bet if you looked at their revenue per square foot, it's probably lower than Walmart. Not because their goods are cheaper. It's just because Walmart does the volume and has more sales per square foot. Another interesting thing and you should think about for your plans is revenue per employee. And so I've looked here at, it's not the most telling statistic for retail. I think probably sales per square foot would probably be a better yardstick. But it's still an interesting statistic here is looking at revenue per employee of $160,000. Let's look at the restaurant business. Again, characterized by, in the McDonald's and Wendy's, pretty lousy gross margins. We get over here to Starbucks, it's kind of like Nordstrom. Better gross margins. Yep.
Full-time or part-time, because places like Walmart have a tremendous amount of part-time.
So the question is revenue per employee. Where do I get that? I'm getting all this information off of the the public filings. So it says Walmart has employees, and it doesn't break out full or part-time. And I'm sure that look at McDonald's here. Their average revenue per employee is $45,000. You would think that there has to be a lot of part-time employees in there, but maybe not. But again, it's like Nordstrom, Starbucks has to pay the piper here and have Wi-Fi and comfy chairs and so even though their gross margins are better, and it doesn't mean that one business model is better or worse. I mean, Starbucks has less operating profit than McDonald's and half the sales of McDonald's. So, just because you wouldn't eat it doesn't mean you shouldn't sell it, I guess. I don't know, the last time I was heli skiing, there was a guy, I said, hey, what do you do? The guy says, hey, I run 5 McDonald's in the Boulder, Colorado area. So I guess it's a pretty good business. But here's the companies that your companies are going to look more like the next 2 or 3 slides, right? So here we get into some tech companies. You probably recognize all these names. The bottom line is, well, not the bottom line, but the gross margin line is great gross margins, all right, with the exception of Dell. And Dell's been in the news lately because they're going to go private because their business model is flawed, is that their business model is broken for today's environment. And you can see why. I mean, they've got Dell is not a technology company. Dell is a supply chain company, and now it's a cutthroat environment to work in. R&D for these companies, with the exception of Dell, are all in the kind of 10 to 15% range, and you'll see this across a lot of companies in the tech area. And then operating profits are across the board, but generally better than the other 2 industries we were looking at. Here we get into the revenue per employee that's going to be more like your companies in the 300. I mean, Dell's a little bit of an outlier here but Cisco's at 575, EMC at 358, and Medtronic is it's in the medical devices area, but it's more like a tech company. In the software space, again, tremendous gross margins. R&D is in that sweet spot that I talked about. Great operating profit, especially for Microsoft. This is a little bit old, so that they might not be doing quite as well now. Revenue per employee, Microsoft 645, but in the 250 to 300 range for these other companies. And then the internet model. It's really every company. There is no kind of internet company. Every one of these companies has their own story, has their own space that they're going after. They're internet-enabled companies is probably the best way to describe this category. But what we can see is, they're characterized by nice gross margins, right? With the exception of Apple, which is kind of a hardware maker, right? While Apple only has 2% R&D, that actually translates to something like $3 billion. So they're spending plenty on R&D. But these other companies are all in kind of Zynga is kind of surprisingly high here. But these other companies are generally between 10 and 20%. I mean, Pandora's a kind of an odd one because they spend so much money on, their biggest expense is paying royalties for the music that they stream. So their revenues are kind of overinflated relative to what we would expect to see in a tech company. But let's look at the revenue per employee. Now look, you've got 3 companies out here with over $1 million in revenue per employee. You might have heard of them, Facebook, Google, and Apple. So but let's look at these other companies, and I would recommend that you kind of model your revenue per employee after them rather than these 3. In the 400, 250, 250, and again, Pandora's at 500, but that revenue is a little bit of an odd number with them. So here we've got 3, so as you put together your plans, I'm going to urge you you don't need to show this to investors, you don't need to show it to judges, but create a line, create a row on your spreadsheet, on your front page or on your quarterly page that takes the revenue and pulls and divides it by the head count from your staffing plan. And if it's quarterly revenue, multiply it by 4 and divide it by 1,000 and look at what that number is. Look at that revenue per employee for every quarter that you are doing your business plan. And as it starts to creep up here towards $1 million, tell yourself, we are not going to pretend, we're not going to tell investors that we're going to be the next Facebook, and just increase your staffing enough to get that revenue down to something that's a little more realistic, right? Because if you're generating $1 million per revenue per employee, your operating profit is going to be way high. It's going to be 40%, 45%, and that it doesn't pass the smell test with investors, because as we've seen, I mean, Facebook's at 44%. There's only one Facebook, right? So, and I will bet that Facebook had a lot of years where they weren't generating 44% operating profit before they got to that point. Business models tend not to change. This is over a 10-year period. I've been giving this talk for 20 years, and so I just went back to some of my old presentations and pulled out some of the companies that I had been updating over time. And I think Cisco is probably the better story here. I mean, their gross margin, it's a flat line. If you look at their sales and marketing, yeah, it increased a little bit over time. Their R&D was just kind of spot on here, as was G&A. And so Cisco, I think what happened is they got into a little bit more of a competitive environment. I mean, back in 98, they could sell as much as they could produce. And they have competitors now, and it's a little more challenging market. But their model has evolved. It hasn't been doing this every year, every other year. And their revenue per employee has been remarkably consistent over that period of time. Yeah?
So business models slowly evolve, but this is obviously for big companies. If you look at small cap or mid-size, maybe you'd see something different, or especially startups.
So the question is, yes, with big companies, the model doesn't change. Well, I guess what I'm trying to show here is that there's a model that works for a certain industry or a certain company, and that's the sweet spot. And your job is to figure out what that sweet spot is and try and show how you're going to grow your business to that. So it's obviously, like I said, it showed on that first spreadsheet with the 4 years, your numbers are going to change, crazy change over that first 4 or 5 year period. But once you get out to year 4 and you're making a 20% profit, then then it's kind of turning the crank, and slowly, at NetScout. Well, let's look at NetScout, right? So let's look at NetScout. I mean, their gross cost of goods, their gross margin went from 68%, 72, 77 to 79 over a 10-year period. That is a tremendous. I mean, think of that. That's 10%. You could, if that could be, if you could put that all on the bottom line, you'd increase your profit by 50%, right? But that was a conscious decision to do that, and it kind of changing the product mix, changing the pricing strategy to do that. So I hope that answers your question. Yeah.
How do you determine what's the right ratio of the annual revenue per employee?
So the question is, what's the right number for your company? It depends on whether you're in software, whether you're in hardware, but it's going to be my sense is it should be something like $250,000 to $500,000 per employee. And if you think, we'll go through employees in a second, and I'll come back to this question when we talk about staffing, okay? So as you think about putting together your model, what is your product? What is the customer going to pay? Is it, what are they buying? and I'm sure people have been in to talk about, thinking about your market and what's the pain that you're solving and what's the problem you're solving and what are their alternatives and stuff like that. But when you put together your model, at some point you got to say, we're going to sell this and it's going to cost that. And so you've got to defend that to investors, that we are selling a box. We are selling a computer that does some specific function, and here's what we're going to charge for that, and here's how we justify that price. Your cost of goods sold should be fairly easy to come up with. It's the material, it's the labor. You're going to have to make some assumptions, but as long as they're reasonable, people will assume that it doesn't have to be to the third decimal place. Is this box going to cost you? If you're going to sell it for $2,000, does it cost you $500 to make, $400 to make, or $800 to make? And then have some backup, to support that, and that would be your cost of goods sold. We'll talk a little bit about distribution strategy, and that's going to impact your business model. As I've said before, R&D should end up at about 10 to 15%. G&A is generally going to be about 5 to 15%. These slides will be available on the website, I think probably by tomorrow. And target an operating profit. So figure out that you build in your operating profit, but don't build in a 40% operating profit. Like I said, I get a ton of business plans, and the number one mistake is people show that they think that by showing more opportunity and more growth, that they're going to be more attractive to investors, and it's kind of just the opposite. It shows kind of a lack of understanding of what's involved in growing a business and what's involved in getting a company that big. But people say, we'll grow this thing to $250 million in 5 years. It's very hard to do that. And as I hope I've shown you, you don't need to get there. Our investors, we grew Net Reveal to $100 million. Our investors were thrilled with the outcome. So you don't need to grow to $250 million for your investors to be interested in the opportunity. And the other thing is that people show me 40% operating profit, which is just not real. It just means that you have not factored in all of the people that you're going to need to hire to support your growth. Thinking about your distribution strategy, it will have a big impact on your business. In this example, we're selling the product ourselves. We have a 60% gross margin. We have a big sales and marketing staff and a 20% operating profit. Instead, and I wouldn't recommend doing this, but this example, it kind of shows you what happens to the numbers if you do make this change, is you find a distributor who will take your product. And it's a $1,000 product, and you say, look, I'll sell it to you for $800. You sell it to the customer for $1,000. You keep the $200 as your fee for finding those sales. But what happens to your model? You still have the same cost of goods sold because it costs you just as much to make that product. Your R&D is going to be exactly the same because you can't shortchange next year's products. You still have to keep turning out new products. Your sales and marketing is going to decrease a lot because you're not to zero because you're still going to have to support that distributor. And your G&A is going to be a little bit lower because you're going to have fewer people and it costs less money and you need less space to have fewer people because you don't have that sales staff. So your operating profit here is still 20%, but it's actually $16 million instead of $20 million. Now what's better? It depends. Maybe by going with the distributor, instead of growing this thing to $80 million in year 2, you could grow this thing to $160 million because they've got so many feet on the street. But I would urge you as you think about your strategy, unless there's a really well-defined distributor who really has a big need for your product and you're convinced that you're going to get mind share from them, Generally, small companies that have a limited product offering are not going to get the mind share of the distributors, and you'll just be another product in their book, and they'll go in and they'll sell whatever the customer wants to buy, and they're not going to make the aggressive sales effort for your product. So I would urge you to think of, of a direct sales force if it's that type of market. There's a lot of business planning software out there. Don't use any of it. Okay, so the business planning software, it's like TurboTax. It asks you a bunch of questions. It's trying to figure out what your assumptions are, and it spits out a nice, neat financial plan. The problem is that you don't see the beauty of putting together your business plan is part that you get this nice statement that comes out. But what it really forces you to do is figure out what all your assumptions are and what those assumptions, how they impact how your business is going to grow. So should we charge $2,000 or $2,500? What if the cost is $400 instead of $600? What if it cost us $400 to make this instead of $600 to make it? What if, so it forces you to play around with those assumptions and see what if our sales force could get up to speed in 4 months instead of a new salesperson getting up to speed in 6 months before they, we hire a new salesperson. It always takes them time to figure out the product and to get established and get that first sale, to get their pipeline full. What if their pipeline, what if it took them less time, or what if it took them more time? So it forces you to think about that and play around with that and see the impact, so that when you get questioned about any of these assumptions, you know the answer because you've already tried the different scenarios. So that's why I would urge you to stay away from business planning software. Your sales projections, this one always says you need to build them from the bottom up. I thought the elevator speech was good. What you did, luckily you didn't say, well, there's a $78 billion market for robotics, and if we only get 1% of that market, then just think, we'll be a $780 million company. Please invest, right? So the problem with that is, think of how diverse the robotics market is and your offering, and so you can see kind of the foolishness of that. So what you need to do is say, we're offering a product. We think that if one factory has the potential to buy $500,000 worth of robots, and there's 1,000 factories in this country that could use it, or there's 10,000 in China, and we're going to have sales guys go out, and we expect each sales guy to close 1 deal a quarter. So that's 4 deals a year, and the average deal is $500,000. So that's $2 million per salesperson. We're going to pay this guy a lot. We're going to pay him $250,000. We're going to pay him, we're going to pay him $200,000, and he's going to cost us $50,000 in travel. But that $250,000 is going to generate $2 million worth of business. And oh, by the way, those customers next year, they're going to come back and buy another $2 million worth of stuff because they love it, so much, right? So that's how you need to think about it. How many customers are out there? How are we going to approach them, if it's with a direct sales force or if it's with other marketing efforts, and what's kind of, whether it's click-throughs or whether it's response rates, those are the assumptions that you need to put in there to build your sales projections. And I don't know if people still do this, but in the old days, people would say, oh, let's do a best case scenario and a worst case scenario and a most likely scenario. The reality is that people have spreadsheet overload these days. They want to see fewer spreadsheets, not more spreadsheets. They want to see summarized spreadsheets, not detailed spreadsheets. Now, it doesn't mean that when they get into due diligence, let's say that someone's really interested in your business, then they're going to want to come in and they're going to want to see all the detail. But don't worry about them coming in and doing due diligence until you at least get them interested in your business. So make a projection and say, this is our projection and this is what we're sticking with. Don't bother to show a lot of different cases. The rules of thumb that I'm going to give you mostly apply to tech companies. So if you're running a consulting business, this probably isn't going to apply. I don't, if you're doing something in biotech, this isn't going to apply. But what I'm trying to do is give you some ideas that will help you put together financials that will appeal to investors and to judges. Staffing is going to drive your expenses. Your average staff, your average employee is going to cost in a technology company. I mean, let's face it. Companies don't have all of the low-level, entry-level employees don't exist anymore. No one has receptionists anymore. No one has administrative staff anymore. So if you look at, I look at Reveal, we had maybe 80 employees. There were probably 30 in manufacturing, so those were actually our lowest paid employees, probably $30 an hour, maybe 60 grand a year, 65 grand a year. But then we made up for that with our algorithm engineers, where we only had, 8 of them, but we were paying those guys $130,000, $140,000 a year. They were all smart guys from MIT, and they needed, So, and then you've got your management team, and then you've got, kind of your rank and file employees. Even your accounting folks are going to be in the $60,000, $70,000, $80,000 range. When it's all said and done, your average employee is going to cost you about, I was a consultant for a company. I walked in, and I'd been there for about a week, and I said to the bookkeeper, I said, hey, do me a favor. How many employees do we have, and bring me the payroll. I was thinking I was doing this class in about a couple weeks. And sure enough, there was like $87,000 per employee. This was a company that I had no part in hiring and putting together their business plan. So employees are going to cost you about $90,000 a year. Benefits, a lot of people get worked up and say, oh, we've got to add 30, 40% on for benefits. They hear stories about General Motors paying guys $25 an hour, but having them cost $50 an hour. That's all accounting shenanigans. All you really need to do is add in 15% for benefits. And the reason is, it's simple. You've got to pay FICA for your employees, that's 7%. And then you've got to offer employees health care. You don't need to offer a lot of other benefits, and the other benefits are cheap compared to health care. So in health care, by the time you have the single people and the families and the people who get insurance through their spouses, 7% is 7 or 8% is a pretty good number to cover your employees for health care. And that's your 15%. So if your average employee is getting $90,000, their cost to you is going to be an extra $13,500. And I'll show you how to put that into your model. Salaries are going to be about 70% of your total expenses. Call it 2/3. Okay? And so as you think about your plans, if your expenses are too high, the first place to look is your staffing plan. If your expenses are too low and your revenue, if you're showing a 40% gross margin and your revenue per employee is $1 million per employee, you got to come to your staffing plan and put that in. In terms of sales staff, this is really kind of a wild card here because it depends on the industry that you're in and what they're doing. And so this is just the companies that I've worked at. I will tell you that sales guys are expensive, but you want the good ones, right? So that's what you're going to need to do. I've talked about sales projections. I've talked about revenues per employee and revenue per salesperson. I think, again, if you're paying someone $200,000 a year, they've got to be bringing in $1.5 to $2 million, or possibly even $3 million a year. I have a case study in here. Someone had asked me, someone asked, where do you get some of this information and how do you think about models? So OpenTable went public about 6 months ago. So I just pulled up their information. I don't know anything about OpenTable other than I make reservations online through them, and they just went public. So I went onto the SEC website and pulled this information up. And so this first page is all data. So is everyone familiar with OpenTable? Okay, so a couple people aren't. So it's a web-enabled technology. you say, I want to go out to dinner at this restaurant with 4 people at 7 o'clock, and it will say 7 o'clock's not available, but 7:45 is, or it'll say it is available, or here's some other restaurants that you can go to. So it's one of those things where when one restaurant is a member, it's not a very good service. But now they've got, I don't know, they claim that they've got 3/4 of the restaurants out there. And now you almost have to be on it, right? Because people just go to Open Table. I mean, it was a brainstorm. And the restaurants, obviously, the restaurants must like it. The restaurants must be getting something out of it, right? They're not missing calls. People can book reservations at 2 in the morning, and they're getting information about the people. So, if you don't show, I'm sure that there's some feedback that they put into your file, and they won't let you make reservations anymore, right? So here's the restaurant. So here's the data. They had 12,300 restaurants in 2009, and they grew that to 15,210. Plus 2,900 restaurants. They seated 43 million diners in 2009 and went to 65 million. And then here's their 3 sources of revenue: subscription, reservations, and installation. And then here's their expenses by department. And I plugged in the percentages. And then in their description, they had how many staff that they had in there. So they had 493 people. Their operating profit was 26 million, 26%. I mean, it's kind of nice because they're 100 million in revenue. All the percentages line up really close. So this is just the raw data. So what did I figure out here? Their subscriptions 44 million, and they had 13,750 restaurants on average that year. I took the beginning number, the ending number, and so they're earning $260 a month in subscription revenue per restaurant. Okay, I broke it down by month. Then they have reservations, 48 million diners, actually 65 million diners, 48 million in revenue. They're collecting 60 cents per diner. So when I make a reservation for 4, they charge them $2.40. And then they also have installation revenue. It looks like $2,400 per installation. So if I sign up as a restaurant, they're going to charge me $2,400 to get started. They're going to charge me $260 a month, and then every time someone makes a reservation, it's 60 cents a diner. Now, I don't know if that's the exact formula, but that's a pretty good guess. So what that says is they have $200,000 in revenue per, so a couple other numbers. They have $200,000 in revenue per employee, and their expenses are $148,000 per employee. And if we estimate that their salary is $100,000 on average, their salaries are 66% of expenses, kind of in line with Charlie's rules of thumb, right? If we look at their revenue per sales staff, I was shocked. I mean, they have 160 sales staff, but if we assume that only 8 of those are actually out selling, and they only generated 36 restaurants per rep per year, that's only $311,000 of revenue per sales staff. But we can look at the acquisition cost. It costs them $6,900. If we look at $20 million in sales and marketing, and they only generated 2,900 new customers, it costs them $6,900 to add an employee. And if the annual revenue per customer, and the average revenue per customer is only $8,000 a year. So as CFO, I'm sitting here going, holy cow. It costs us $7,000 to add a customer. In the first year, I only make $8,000. So I better build that into my model because we're going to need a lot of money to get this thing off the ground. But yet, in years, the customers, once we have them, it's an annuity, and we're never going to lose them. So the 5-year customer is going to generate $70,000 in revenue. So clearly worth, kind of this 1 year, first year expense, because there's no selling costs in the second year. They're going to keep using the system, and the system's on autopilot at that point. So what were the decisions? They had to think about who's going to pay for this service. Okay, so they decided it's going to be the restaurant. But how are they going to pay? And how do we charge the high-volume restaurants from the low-volume restaurants? And how do we cover, the upfront installation costs? And I guarantee you their model changed over time. I bet the first restaurant didn't pay a dime for the computer that went into their system, right? And maybe they only paid per diner. I don't know. I don't know how their business evolved until they got that critical mass. but they found, but they somehow zeroed in on, fine-tuned this formula to find one that works, and a 26% operating profit, is something to be pretty happy about. Yeah.
The red flags you had in previous slides.
Yeah. So in their literature, it said that there's this seems like a low number. It seems shocking to me that they would have 75% of the restaurants. Now maybe they define restaurants as restaurants that take reservations, right? So there's McDonald's, there's sub shops, there's D'Angelo's. Those don't count. But they're saying they have 75% of the restaurant market. And now their challenge is only 10% of diners make their reservations through OpenTable. So the problem is, what do they do for an encore, right? They've already populated all of the restaurants. Now what they need to do is incentivize the customers to use their service and make more of their reservations through them, okay? I did the same thing for LinkedIn, and this is on there. So it's interesting to go through and see how LinkedIn, they do have a little bit of an advertising model, so you can kind of see how much advertising revenue they're able to generate per member. So kind of interesting to look at. You've got to have a cash flow projection in your financial plan, but the cash flow is probably the most challenging financial statement to pull together if you're doing it off of a spreadsheet, if you're not doing it with accounting software. Because the cash flow, it takes the income statement and translates it to the balance sheet and then looks at changes in the balance sheet to figure out what number cash you have. Cash is kind of the plug number that makes this whole formula work. And if you have any mistakes in your transfer from the income statement to the balance sheet, then the cash number is the place where it's going to show up. So, and since that's the only number that is really important on a cash flow projection, it's very prone to error, okay? Now, you can do it you can do it kind of the classic way, and if you have the time, knock yourself out, okay? It's a worthy exercise to do that. But the quick and dirty will give you a pretty good sense of where you're going to be. And that is looking at your operating loss each month or each quarter and just adding those up until you become profitable. Because generally companies, they don't, especially in your business plan, you aren't profitable, unprofitable, profitable, unprofitable. You're not bouncing back and forth. So it's kind of once you turn a profit, then you should be profitable going forward from that point on. So add up those operating losses to that point and add in your capital expenses, which would mean any equipment that you had to buy, any furniture, any computers, and that'll tell you how much cash you need. And so that's something to tell you'll be asked by your investors. How much cash are you going to need to get this thing to this phase? Or how much cash are you going to need to get it to the next phase? And so this is a pretty good, estimate. And so I would say even if you do a full-blown cash flow projection, do it this way. See if the two lines are reasonably close, then you've probably done it the right way. If they're not close, then I would look at how you've done it kind of the formal way and figure out what's out of sync there. How much should you pay yourself? What I would say is don't say I'm CEO of this great, I'm going to pick on this guy because he gave his elevator speech. I'm CEO of this great robotics company, and we did an industry survey, and I mean the CEO of iRobot, I mean that guy made like $5 million last year. And these other robot companies, they're all making a lot of money. So I'm going to pay myself $350,000 or $400,000 because I'm CEO. In reality, I think what investors are willing to say is what could you earn if you left MIT and went in and joined one of those big companies that I said you should really think long and hard about joining? Okay. What would they pay you? I mean, if you're an algorithm engineer and you can make $140,000 or $150,000 at Google, you know, that's probably, I'm not sure you should pay your, you know, I mean, that's such a specialized niche. You know, that's maybe on the high end of the salaries. But, you know, pay yourself a living wage. Investors want you, like I said, they don't want you to starve. They don't want you to be worrying about making your car payment. They don't want you to be changing the oil in your car to save a few bucks. They want you to be working, you know, 16 hours a day at this company, right? So they want you to be able to pay your bills. They want you to be paid a living wage. But remember, the less you pay yourself, the less you're going to have to, the less money you're going to have to raise. And the less money you raise means the more equity that you have. And when you get to the happy ending, the more equity you have means the more money in your pocket. And the $10,000 that you don't pay yourself today, if that were to translate into equity down the road, it's going to be worth a lot more down the road. And it's not just your $10,000, it kind of your salary sets the tone for the whole company. So I'm not saying you should be cheap, but I'm just saying you should be, you know, you should be cost conscious. Okay? So I hope that helps. So they don't want you to starve, but they still want you to be hungry. They don't want people to just say, you know, hey, life is pretty good. You know, I can afford anything I want on my salary.
Charlie, a time check?
Yes, so we have 15 minutes, 10 minutes, okay. So now we're right into the spreadsheet. So what we're trying to do is get to this spreadsheet, which is a 4 or 5 year plan. And you'll have to, you know, you'll have to think about your business and whether, you know, I almost think 6 years is asking your investors to have a lot of patience. And so what they want to see is how big can, not that, you know, they know you're not going to fall off a cliff at the end of 4 years. You're going to keep growing it. But how big can you get there in 4 or 5 years? So I've color-coded this thing so you can kind of get a sense of where information is, how information is flowing around this thing. And if it's in blue, it means it's from another spreadsheet. So this spreadsheet, everything on this spreadsheet is from another spreadsheet, with the exception of things that are calculated from data from another spreadsheet, right? This is, I would urge you to do a quarterly financial plan. You've got to do 4 years, right? You've got to do at least 4 years, maybe 5. And 4 years at monthly is 48 columns. And you're going to be fat-fingering in staffing plans and expenses. And so if you say, oh, our staffing plan is too high, now you've got to make 48 changes, it's just too prone to error. And there'll be, so just do quarterly. When they come in as part of due diligence or after due diligence, they're going to want to see a detailed 1 and 2 year plan monthly, certainly for the first year. But use your 1 year quarterly as the template, and just explain that. Just say it's not going to match up perfectly, but make it match as close as you can, and they're not going to expect these two to tie out, right? Again, remember, spreadsheet overload is what people have these days. So you've got this quarterly, so you've now got, you know, so here you're going out to Q4, year 4, right, out here, right? But again, look, everything on this spreadsheet is in blue. It's from another spreadsheet. So now we get to some of the hard decisions and the hard assumptions. On your sales and cost of goods sold forecast, here I've got a company that's selling product. Maybe you're not selling product. Maybe you're selling ads, and so you've got it based on views and click-throughs, or views and, you know, and ad revenue per million or per thousand. But so your input here is the number of units that you're selling. I happen to have a couple of models here, and then I plug in anywhere that you can put in a formula. I would urge you to do that, because then you can make the change once and it propagates to many, right? So here I've got the revenue per unit here, but I've got it multiplied by the units here, and this is a calculated number that gets sent to another spreadsheet. Same here as my cost of goods sold. So I was saying, what if our unit, what if it was $2,250 instead of $2,500? Or what if we uncovered some new technology, some new way to build this thing, or we thought of we found a new 3D printer that could do it for half the price? that might radically change our business. We might be able to drop the price, and that would allow us to increase the number of units, right? If we could, so as these things change, you're going to keep playing around with this. So then your staffing plan. You've got one staffing plan you've got two staffing plans. One is the number of people, and then one is the cost of people. And these two are kind are closely linked. Here's the staffing plan that everyone wants to see, and I would urge you to put a summary of this in your business plan. It's just the number of employees, the employee type, and then you just input the number of people in that position. I would urge you to compress the number of positions, so you don't need to have 3 different levels of programmer, just have 1 level of programmer. And yeah, you're going to pay some of your programmers $70,000, some of them $90,000, and some of them $110,000. Average the 3 out and say we're going to pay employees, $90,000 or something. So whatever that, compress the positions, because again, you don't want to get this thing unwieldy. You'd have all your departments down here, your accounting department, your sales department. So this spreadsheet would go all the way, again, it's also going all the way out here. You then have salary expenses, and so you just, for that position, you plug in a salary amount, and then here's where we put in the 15%. And one of the problems that companies have out in the out years is that the expenses aren't high enough. But the reality is that employees, even at startups, want raises. So what I did was I built in a 2% raise per quarter, which works out to 8% a year, which is a pretty good budget for salary increases over a period of time. And that helps you with your problem out here, because think about it, this is now 25% higher than it was here. But that's how it works in the real world, is people want their raises every year, and people who don't get raises, they're usually are not too happy, and they start looking around. So you got to build it into your plan. And so this number here, I just added all the numbers and send that to my departmental expenses. And here's our departmental expenses. So we take salaries and benefits from the staffing plan, and then we add in all the other stuff that you need to buy. So again, here's an example where you can use a formula. Engineers like to buy a lot of stuff. And so they need oscilloscopes, and they need cables, and they need software, and the list goes on. And of course, everything, they say, well, do you really need it? Well, no, but our product's going to be late if we don't have it, right? So it's hard to say no to these guys. I will tell you, this is from 2 companies. I have budgeted, honest to God, $2,000 per month per technical person to buy stuff. And it works out pretty good, to be a pretty good number. It's just like for travel. Any employee that travels a lot, budget $1,000 a week, and that you'll come in under that, but you'll feel good about it. So, but it's hard to spend more than $1,000 a week consistently and be gone from home 52 weeks a year. So here's this formula, and this just takes the $2,000 per person per month and multiplies it by the 5 engineers we had in Q1, and we come up with $30,000 in expenses in that group. But some of these are just going to be plugged in. Trade shows is something where if things are too high or too low, it's always easy to just plug in a trade show. That's a great place to blow some money if you've got, if you're way over, if you're showing too much operating profit. And then here's your other departments. You could use a percentage for your commission for your salesperson if that's appropriate. You can, for some of your G&A expenses, you can use per person per month, $200 for telephone and postage, although who even needs a phone anymore, so that's probably less than the last time I put together a business plan. And so you take all these together, and it pulls it to your quarterly P&L. And then the last one I want to show you is kind of your CapEx. And your CapEx takes the gross margin from your P&L. The one thing that I did was I offset that by a quarter, because customers always want to delay paying you. Okay, so your gross margin is going to show up a quarter late. But your expenses are going to show up. Remember, your expenses are 66% of your expenses are salaries, and employees like to get paid in the current quarter. So that's going to show up in the current quarter. So that kind of, that does build in a little bit of delay in terms of getting payment. And then you just add in your capital expenses. And so I put together a little CapEx table here of, and again here, use a formula if you can, right? So every new employee needs a $4,000 workstation, right? Well, it's probably $2,000 today, but whatever, whatever they need. And then prototype expenses is just a fat finger number here. And so that number just comes right up into here. And then in your cash flow, never show that you have negative cash. Show that you raise enough money in order to keep your cash positive. So raise $5 million, and then somewhere out in here, that money will be, that cash balance will be close to zero. Oh, look here, it's almost close to zero. So then show in this quarter another $5 million. So you say to your investors, we're going to need to, we're raising $5 million, and that's going to take us for 1 year, 18 months, 24 months, whatever it is. And then we plan on doing another raise of maybe it's $10 million, because at that point you've got 100 employees and $5 million isn't going to last as long as the first $5 million. But you have a product and you want to do sales and marketing and blow a lot of money on trade shows. So you plug in another, another tranche here. And investors are happy to see that they're fine with you having to raise more money. What they want to hear is, what are you going to accomplish with the first set of money? You can't get halfway there with the first set of money. You're going to have to raise enough money the first time to have something to show them and then be able to raise it. So there's some suggestions in here on what you should put in to your business plan, but I think we've covered that all. Any last questions before I have 30 seconds? Yeah?
How about working capital? Do you need to get specific?
That's in your cash flow plan. Just show that you have cash in the bank. I mean, that's really, that's sufficient. That's the whole, that's right. That's what I'm saying. That's a lot of work. If you get done with everything else and, man, that thing looks great, then go ahead and you can do that. But it's a lot of work to get to that point. Yeah?
Talk about splitting the pie a bit.
Do you have 5 minutes to hear about how to split the pie?
All right.
Okay. We'll cover it again next week. All I would say, so what I want to do is talk, so think about your spreadsheet here. All I would say is that the work that has to be completed is always much more than the work that has been completed. So there's a lot of things that go into dividing up how much equity people have. Internal equity is a really important one, because you should, while people aren't supposed to talk about how much stock they have, they will talk about it and people will find out. Now that doesn't mean that the guy or woman who joined us when we were 10 people in as a pure startup, no one's going to begrudge early employees for getting more stock than later employees. But what you have to do is have kind of a plan so that employees who generally join at the same time generally have the same amount of stock. That doesn't mean you can't negotiate individually with employees. Some people are more interested in the cash compensation, and some people are more interested in negotiating on stock. But you got to have some guidelines. I feel that all employees should vest, even in a startup. And the reason is that there's 4 of you right now starting this company. And everyone's gung-ho, and it's going to be great. But then, so we draw up some paper, and everyone has 25% equity in the company. And then 6 months into it, Joe decides, hey, that Google job, Google called back, and they're going to pay me 140 grand. I'm out of here. And so now the 3 of you are stuck trying to figure out, how do we get the 25% equity that we gave Joe back, because we're carrying his water we're going to make this guy rich, and he's going to be making a lot of money working for Google. So that's why I think everyone should vest over 4 years. and including the founders. So you don't have that problem where you've got someone on board who's someone who has equity that they didn't earn. So once you have a couple rounds of financing, these are some kind of rule of thumb percentages that I've seen across a lot of companies. And I would say the CEO is going to have 5 to 10%. The VPs are going to get 1 to 2.5%. And so I'm thinking of once you've had 2 rounds of financing, if you want to go out and hire someone, this is what they're going to need. Okay, this is what you're going to what it's going to take to get them. You know, if you're going to bring me in as a CFO, you know, it's going to take 1 to 2.5% to get me there. Okay, senior managers about 1/4%, and individual contributors about 0.1%. And so you don't know what that number is going to be until you look at your whole cap table. Your cap table means who owns the stock and how many shares do they own. Okay, so whenever you hear that term cap table, all it is, it's a listing of all the shareholders and how many shares they own, and it's nothing more complicated than that. So founding management might get 2 to 3 times these numbers. Okay, so a founding CEO, it's not uncommon for a founding CEO to have 10 or 15% ownership, especially if you manage the dilution properly. And founding employees might get even more than that. So we had senior individual contributors who had, you know, 0.5%, which is something they would never get. So we had, you know, never get if they'd come on later, but they were critical employees to get on board early. So just like my business model, I say start at the end, then go to the beginning and keep playing around with it till you get the end to come out how you like it. So here what I've done is I've shown a bunch of categories of employees, and this is pretty similar to what we did at Reveal, and their ownership percentages, and then I've taken this per person, so I've taken my managers and I've figured out what their per person ownership is. So I've got 10 managers combined, they have 1.8%, but works out to 0.18%. And what did I say, about 0.25%? So that's kind of in the ballpark. And then we have 0.9% and 0.5% here, right? So here's the steps that we went through. We had 3 founders, and they decided to divide the equity 50, 25, 25. This is, I can't give you any answers on how this gets done. That's up to the team and the value that people bring and the commitment that they bring. The next step is we had some key early employees that we had to bring in. And so this is a little bit of horse trading and figuring out, looking at what you have. You know, if you're the CEO, what I have, what should these people have relative to me, relative to where we are in the company? And also kind of factored in, even though these employees weren't hired, factored in an option plan number here. And we'll come back and play with these numbers if we get out here and it's not the right number. But so here what we plugged in is per person numbers for these people, and we kept playing around with these numbers once we got out here to see whether we liked it or not. Then we brought in some angel money, right? So we had angel investors, again, that's $500,000 at 4.5, so they got 10%. So everyone got diluted by 10%. So someone who had 1.1% had a little less than 1%, right? Then we brought in our next round of venture money. Those guys got the 50% that I've been talking about. And then the final round of money was the venture round where they got, in this example, they got 50%. In my earlier example, they got 40%. But look at what happened to our investors in round A. They got diluted from 50% to 25%. Our angel investors went from 10% to 5% to 2.5%. Okay? But more important is what happened to you, the CEO or the CTO, right? You still had 2 million shares all the way across, but you went from 50%, 32%, 29%, 14%, and 7%. Now look, these numbers, you're not going to be able to do too much about those. Okay? The market is what the market is. It's whatever space you're in. If it's hot, maybe you can take less dilution or raise more money for the same dilution. But you're not going to be able to go out and raise unless you're in something that is, unless you have something that's truly unique. You're not going to be able to go out and raise $5 million. This isn't Shark Tank. You're not going to walk in and raise $5 million for 20% of your company. You're going to give up 35, 40, 45, 50% of your company. But in subsequent rounds, those guys are going to get diluted just like everyone else. So then you look at these numbers here and make sure that those are kind of within what's common in a technology company. And play around with these absolute numbers to get them in the right place. So that's what we did. We set up a chart like this. We gave our early guys, we knew what we wanted to give our early guys to get them on board. And then we played around with this chart to have our range, and we stuck with that range. We said a manager coming in is going to get, we said 40 to 50,000 for a director level employee, and that was, that was part of our package that we put together for people. So I hope that was helpful. My email's on here. Feel free to shoot me an email if you have any questions. Thank you.